Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Joining us now around the table, Oksana Aronov of JPMorgan Asset Management. Oksana, thank you so much for joining us. You just heard from Kathy there, talking about the markets pricing in this Trump trade. When you look at the rise in yields, is that economics or do you think it's politics?
So I want to start answering that question actually by zooming out a little bit, because we spend a lot of time in markets trying to predict rates. Obviously, that's the backbone of the market, whether you're talking about bonds or stocks. But the reality is that when we look at the history of how good is the market consensus provided by Bloomberg at predicting where the 10-year will be, it's actually pretty terrible. How good is the Fed at predicting where the Fed funds will be? It's actually pretty terrible, because if you look at their dot plot, in an extreme example, in 2020, they expected the Fed funds to stay at zero all through most of 2023. So with these things in mind, and by the way, even when you know what the Fed is going to do, and they do it, like cut 50 basis points earlier this year, which seemed kind of unnecessary given the strength of the economy, but they did it. What has happened to the long end of the curve against the calls of extending duration? The longer end of the curve moved up with 70 basis points. So all of this to say that I think everyone needs to have a little bit of humility and really focus on the economy and the data. And Powell himself said last week that, look, we're not going to prejudge anything. We're going to be really looking at the data. And I think that a lot of what's in the mix right now with the new administration coming in is potentially short-term, at least, looks quite inflationary. And that means, possibly higher longer-term rates, which of course are also looking at the state of our balance sheet. And that process started way before the election. And we've been saying that, look, regardless of who occupies the White House in January, there is really no focus on fiscal spending. I mean, everyone wants the accountability in theory, but everyone wants to spend on the things they want to spend.
So is that a 5% on the 10-year?
So if you look at what the market is currently pricing in for the Fed funds rate, we have about a 3% rate by the end of next year. Historically, the spread between Fed funds and the 10-year Treasury is around 175 basis points. So you do the math. So even if markets' expectations come true and we have a 2.93% Fed funds this time next year, is a 5% 10-year more likely, or a 4% 10-year more likely, or a 3% 10-year, right? So if you believe in a positively sloping curve, that 10-year is going to be likely higher as opposed to lower, not to mention all of the longer-term issues that are inflationary that we can talk about, but that's just the math. Now, what will actually happen? Your guess is as good as mine. Again, and that's why we do not pin the fortune of our process on the directionality of rates, and maybe that's why we've actually outperformed strategies that track indices in fixed income by 14 to 16% over these last very volatile 3 years in fixed income, which is a lifetime of return in fixed income, frankly.
Well, to that point, before we'd gotten the 50 basis points of cuts and yields move higher, so many people had talked about the reinvestment risk in this market, that you need to be going into bonds because yields will come lower. What psychological impact has it had for investors for that not to play out? And how real, still at that moment, is this reinvestment risk, if there is some potential for yields to go higher from here?
So right now, as we look out, and it seems that a higher for longer environment is more likely, and the Fed is going to be looking at the data, and to the extent that that data continues to be strong and we possibly see even an uptick in inflation, they may stop cutting or even take some of those cuts back. So we definitely believe there's nothing wrong with cutting or not cutting, clipping that coupon at the front end of the curve, and that's been the right trade. And so we like things like high quality corporate floaters. They still give you a yield above traditional kind of front end money market type yields, and incredibly high quality. To level set kind of what's happening in the lower credit market, because that same thinking has pushed people out into lower rated, junk rated parts of the market. You have high yield spreads today sitting at 285 basis points over treasuries. It is extremely rare to see a spread inside of 270. This is incredibly tight. And the last time we saw spreads in these levels, at these levels, were just before the GFC and just before kind of the bubble burst in the late 90s, early 2000s. Not to say that we're headed there, but to say that, look, these valuations are definitely pushing against historic.
Yeah, IG even more so, 74-ish, I think is the spread at the moment. Tightest level since 1998. John likes to ask this question. He's not here, so I'll do it for him. Are we heading into an environment where you could see yields on credit on IG below that of treasuries?
So again, we've seen a lot of unprecedented things unfold here. I would point out that the yield on double Bs, which is the higher tier of high yield, versus the yield on 3-month treasuries right now are within hairs kind of distance of each other. So why would you buy that junk rated, right, with a 6 handle on it, or a high 5 handle on it, where you can get basically that risk-free in 3-month T-bills, right? So, and if there should be a revaluation tomorrow, which we think is very likely, because to your point, IG is quite tight, and about half of it is triple B rated. So you have this enormous cloud hanging over the high yield market, and you've got names like Boeing, like Paramount, right, that don't really have an opinion on them, but you are reading headlines around their credit quality. Are they going to drop into the high yield index? That has very serious ramifications for valuations there. So at the end of the day, investors always have to ask themselves the question of what is priced in? And do I want to just let an index drag me through the experience of this repricing, whether it's caused by just higher for longer, whether it's caused by a slowing of the economy, whatever it is? Or do you want to have an active management approach that can actually take advantage of these different valuations? To your point about investment grade, one of the cheapest trades out there right now is buying protection on credit via selling it on investment grade. Cheap, 40 to 50 basis points, all-time kind of low cost, and we're taking advantage of that. But that's not the sort of thing you'll see in a market risk-driven strategy.
You say that credit is expensive and that there are a number of risks out there. I look at the Bloomberg Corporate Bond OAS. It's the lowest, 74 basis points. It is the lowest in a century. What is the biggest risk? If we're sitting around this desk every day talking about U.S. exceptional, the fund flows that will come in here, the FDI that will come in here, the migration, not just migration to the dollar, but the sheer flow to the dollar has been immense. So what is it that challenges credit then?
So it's interesting you mentioned flow to the dollar. So if you look at assets coming into the U.S. 10, 12, 15 years ago were overwhelmingly going into treasuries and credit.
Yes.
Today, they're overwhelmingly going into equities. So there is incrementally less dollars going into the dollar or less money going into the dollar on the credit side. And when I talk about, and when you talk about, pricing being very tight, spreads being very tight, it doesn't mean we are expecting a recession. The economy appears to be strong. But the problem is when something is priced for perfection, it takes anything other than perfection to move that price. And lower rated credit is notoriously volatile, right? So just this higher for longer environment, yep. If it doesn't materialize that the Fed gets us to, high twos and we have to live here longer, that's a problem for cash-strapped, junk-rated companies.
Give us your opinion. Steve Raschuta was with Danny and I last week, and we were chatting about, it'll be the bond vigilantes that will restrain the fiscal largesse of Washington. They will return. It will be 1995. And Steve sort of leaned onto the desk and went, there aren't very many bond vigilantes left. So contextualize that for us. Do you believe that, he talks about a migration to other markets with Danny and myself. Do you think the bond vigilantes can be reborn? Are there so few of them?
So again, I like to stick to the facts and the data. And we know that where does the demand for treasuries come from overwhelmingly? It comes from the Fed, it comes from U.S. commercial banks, and it comes from foreign investors. The Fed is QTing. U.S. commercial banks cannot get rid of their treasury holdings fast enough. And foreign investors are dominated by China. It's China and Japan. And China, of course, we know the issues around the relationship there. There are not enough stores of value in the world, so China has continued to buy our treasuries, but at a smaller, lesser pace. Mm-hmm. So the major sources of demand for treasuries are not what they used to be, and therefore we're seeing some weaker auctions. And so I can't speak to the bond vigilantes, but we are certainly seeing some underpinnings that are in the process of change. And these things always happen slowly, and then suddenly. And so that's been part of the reason why we've seen the long end of the curve migrate higher, along with better growth prospects, perhaps a return of inflation, on balance, probably not back to 9%, but somewhat of a return of inflation. All these things are not going to allow the 10-year to move significantly lower in the absence of some exogenous shock that comes out of nowhere that we cannot see, obviously, but that's why we have high-quality allocations in portfolios.
Oksana, if Jonathan was here, he'd call it a clinic. I know he's disappointed he missed this. Thank you so much for your time this morning. Thank you. Oksana Aronov there of JPMorgan Asset Management. Richardson of ADP joins us now. She's looking forward to all of this and maybe also playing a little bit of scenario analysis when it comes to 2025. Let's just start the week off. What are you looking most forward to?
I'm looking at CPI because it's going to be so important for how the Fed conducts itself over the remainder of 2024. But I think the sleeper of the week is initial jobless claims. Here's why. We saw a really negative private sector print from the BLS for October. So we should see some indication in this high-frequency data that companies are laying off. We haven't yet. It's still super low, and that's an indication that the BLS number may be revised higher or that the labor market looks a bit stronger than that last report would suggest.
It's a really good point. It was the government sector that added to jobs last time around. Right. So in this scenario where you don't see that coming through, can we also go back to this thing of, okay, the last month's data, it was all weird. It was hurricanes, it was strikes. We basically have to discount it all.
I think there are some threads that we can hang our hats on. This very low initial jobless claims number that's high frequency is one of them. We're seeing strength in the labor market at ADP. There was hiring in the JOLTS report also coming out of BLS. So there are some hangers we can use, but definitely we want to look towards the future to see if there's evidence of weakness. And then coming back to that CPI print, super important, looking at services and the role that labor market will play in pushing up or restraining service sector inflation going forward. That's going to be very important.
Well, in the spirit of looking forward, it's a 2025 where the outlook is just so uncertain. We don't have any great economic models for what adding 7 3/4 into the U.S. deficit will mean. Does the Fed need to start talking about scenarios? Do they need to start laying out different futures that they might face? Or should they continue with the line, we need to wait and see?
I think the Fed is always looking at scenarios. So I don't think this is a net new policy. I mean, they have 400 economists. They have to do something with their time. So I think scenario analysis is
the easiest job in Washington. You flip a coin.
Come in and flick a coin. Off you go.
Scenario analysis is built hardcore into their policy framework. What I think it's going to be very important for a data-dependent Fed is to have a consistent framework. And that's the task of the next few months, is to reevaluate that framework. It's time. The last time they revisited it was in 2020. It was a different inflation picture then. Now they have to kind of rejigger that framework to fit the scenario that they're in right now. This idea that inflation may bounce back, it might be a little bumpy, and that trajectory is very different than too low inflation, what we had going into the pandemic.
Look, the narrative around tariffs, we will know incrementally, whether it's 20%, 30%, and that could be on your allies, not your enemies. On your enemies or perceived enemies, it's China's 60%. Currently, it's 2% on the trade-weighted assets that are imported into the United States of America. That is going to go potentially to 20% of the imports into the United States of America. Extrapolate that for me in terms of potential inflation, but more so the drag on growth.
Right. So the U.S. has benefited in this soft landing outlook that it looks like we're still on that trajectory from a very steady global picture. The IMF has called the global economy underwhelming but steady.
Yeah.
So it's not been a headwind. It hasn't been a tailwind. Tariffs could change that a bit, whether global growth becomes, in fact, a tailwind or a headwind in the short term versus the medium term versus the long term. Those are all scenarios that have to be penciled in. But it's really important that people remember that the administration during the first out of list, a product exclusion list.
Yes.
It wasn't just
carve-outs.
across-aboard tariffs. The carve-outs matter, and they'll continue to matter as we go to these bigger, more macro tariff policy implementations. What's on that list? And until we know what the product exclusion list looks like, we can't really handicap what's going to happen with the economy.
And I saw some pretty good articles over the weekend talking about Canada and obviously the amount of energy that's imported from Canada. You know, and again, that would be one of your closest allies. It's certainly one of your closest trading partners. As you look at the fiscal kind of narrative, and this was one of the big stories and one of the big things that we wrote about going into the election under Harris. It was going to be just under $4 trillion under Donald Trump. If everybody gets a tax cut, literally, you get a tax cut, you get a tax cut, you get a tax cut. I can't remember where that came from. I think it was Maya McGinnis and yourself. But on a slightly more serious note, that is a deficit of $7.75 trillion. We're not going to get everything that he promised, are we? Again, you talk about the carve-outs, but it's also about what he's going to have to walk back from a tax perspective.
You know, what's said on the campaign trail and was actually done in D.C. as someone who spent almost 20 years in D.C. And several of those years as a government economist, like trying to translate that policy into legislation, into law, they're very different things. The sausage making is real, democracy is hard, and putting it all together means that what you say and what actually is done is very different. That being said, you know, when you look at the big picture, whoever, you know, the path forward is with a very stable U.S. economy. But the big dragon, it's not even an elephant anymore, the big dragon in the room is the fiscal deficit. No one talked about that on the campaign trail. It was not a political issue. Nobody wants to talk about it because it's such a big dragon to slay. And so that's a problem not just in the United States, it's a problem throughout the world. And it is a problem that could reignite inflation by crowding out investment and crowding out the ease of capital allocation to other parts of the world, which leads to a below capacity productivity, which lowers growth. So it is an issue.
Paying off your debts doesn't win elections. Could we potentially, though...
But it wins economies, so there is a tension there.
Could we maybe be on the downward trajectory of this idea, then, of U.S. exceptionalism?
I don't think we're there. I think there is plenty in the U.S. that keeps the strong growth narrative alive. But we can't take it for granted. Productivity is lower now than it was going into the pandemic. That's worker productivity. And the way this country grows, the way it's always grown, is when there are more workers and those workers become more productive. And we know that there's plenty of technology out there that could make the U.S. worker more productive. The question is, will it get translated through the capital markets into the companies, especially the small and medium enterprises that need to see that productivity enhancement with their workforce? That's a big open question. And also the interest rates we have to pay to move that capital is a big open question, and fiscal debt could affect those rates.
The real sausage making. Washington and the financial markets. Nela Richardson of ADP and also Bloomberg contributor, thank you so much for joining us this morning. And Fed speak on deck this week, including remarks from Fed Chair Jay Powell on Thursday, just 1 week after the FOMC cut rates by another 25 basis points. Former Obama economic advisor Jason Furman writing this: monetary policy is going from very contractionary to reasonably contractionary. This makes sense given that inflation risks are much lower than before, but we are still higher than recession risks. I expect another cut in December, but core PCE inflation is likely to rise, making a continued process of cuts at every meeting difficult. Jason Furman of the Harvard Kennedy School joins us now. Jason, thank you so much for your time. I know you're looking at potentially this cut in December, but give us some clues on what the heck 2025 is going to look like when policy can be vastly different that this Fed needs to recalibrate for.
Yeah, first of all, separate from anything related to policy changes coming from Donald Trump, we're probably going to end the year with a core PCE inflation rate of something like 2.8%. That's usually your best bet for what inflation is going to be going forward. Then you add to that some fiscal expansion, some tariffs. We don't know the magnitudes of those, but they both push in the same direction. You're adding even more to inflationary pressures. I think that's going to make it hard for the Fed to continue its process of rate cuts at anything like an every meeting pace next year, maybe every other meeting at best. With an exception, if the economy starts to weaken, they'll be there. But absent that, we have strong growth, we have high inflation, hard to keep cutting.
Hang on, Jason. So save for their cutting bias, should they even be cutting in December? Does that even make sense with the environment that you just laid out?
Yeah, interest rates will still be contractionary after one more cut. In some sense, the way the Fed operates is they always wait longer until they're really sure, and then they start a continuous process of change, and that's where they are now. I think it would be sort of too shocking to the system to pull that one back. It would almost also look a little bit political. But yeah, after December, they need to take a hard look at the data, and I don't think it's going to say, keep cutting.
If we can go to that environment where you have higher yields and a stronger dollar because of whatever the Trump policies are, but because they're not cutting every single meeting, that means you globally have tighter financial conditions and maybe force rate cuts elsewhere, which again feeds this feedback loop of stronger dollar, higher yields in the U.S. Jason, what is the likelihood of that type of global environment where you do get this sort of doom loop with rate differentials?
Look, in some ways, a weaker currency is useful to a lot of countries around the world, which are struggling with demand. The higher dollar, in a sense, is shifting demand, from the United States to those countries. So in some ways, that's going to help with the global equalization. But Europe is in just a very different place than us right now. They have really weak growth. We have really strong growth. That means monetary policy should be different in those two economies.
Jason, good morning. You wrote in the Journal in September time that Trump often listened to sensible advisors and walked away from some terrible economic policies as a president. What do you think he will walk away from? Anne-Marie's been making this point that he's watching the betting markets, he's on Twitter, he's on Truth Social, he's watching everything. What's the worst policy that he will walk away from the campaign trail?
My guess is that, well, first of all, interfering heavily with the Federal Reserve, I think he'll walk away from that. The market would punish that very severely. Second, I hope he walks away from across-the-board tariffs on every country in the world. On the one hand, he does have a deep-seated belief in that. On the other, that would just be really destructive to the U.S. economy. Where I don't think the market will put much pressure, though, is on fiscal expansion. Do I think he could do, the $8 trillion he proposed on the campaign? Probably not. Do I think he could add $5 trillion to the deficit without tanking the market? Absolutely, yes. And so it's that fiscal expansion that I think is the most likely to make it through the screen.
I'm curious what you define as tanking the market. My inbox is littered with 5%. It's like a number that keeps ringing up on a cash register at the moment on the bond yields. So just talk me through that.
Yeah, look, we get to 5% on the 10-year. I think that will get attention, probably from the president, and if not from, four Republicans at least four Republicans in the Senate. That's what our fiscal conversation to date. We had too much deficit increase over the last 4 years. Harris was proposing too little deficit increase. Both parties are a part of this, but part of why they have is that interest rates have allowed it and the bond markets have allowed it. Let's see if the bond market vigilantes come back when they start hearing about these multi-trillion-dollar deficit increases.
Well, Larry Summers was saying that maybe it's going to be up to the bond market to educate lawmakers in Washington, D.C. Do you think that's what forces Washington to coalesce around actually being a little bit more disciplined when it comes to the U.S. trajectory, the fiscal health?
Yeah, I think that's pretty much the main thing that could get people's attention. I would have thought that the Social Security and Medicare trust funds being exhausted within a decade would get people's attention. I would have thought, nearly $2 trillion deficit at a time when the economy is really quite good would get people's attention, but those haven't. So yeah, I think we need the market at this point.
So that's basically a Liz Truss moment. Is there a timeline, Jason, that you think this could happen? I mean, with a Republican trifecta, nearly, once we get the results of the House, do you think it can happen in 2025?
It can always happen, but it can always not happen. And I realize that's super unhelpful, but it's not like there's some mathematical link between here's the quantity of deficit and debt and here's some discontinuous change in interest rates. Markets are trying to assess not just where the deficit and debt are, but where they feel policymakers could go or would go with it with future actions. I think with Liz Truss, it was the sense that she was just completely recklessly ignoring any sense of discipline around this. That then interacted with a set of quirks around insurance companies, regulation, and the like. Things like that are hard to spot in advance. But yeah, that's what I would be worried about if someone picked, in the unlikely event that someone picked me to be Donald Trump's Treasury Secretary.
I hate to say that to you, but it's a very unlikely event. But former Obama economic advisor Jason Furman, thank you so much for joining us in your time this Monday morning.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.